Now then, a look at the latest forecast from the Organization for Economic Cooperation and Development. You and I better know it as the OECD. They upgraded their outlook for the global economic growth to 3.6% this year. That's up 0.1 percentage points rather from prior estimates. The organization in fact also enhanced the growth forecast for the US slightly for both this year and 2018. For China though, the OECD kept its outlook pretty much unchanged at 6.8% growth this year and 6.6% next year. The OECD said the euro area growth might actually be stronger than expected if the UK does maintain the closest possible economic relationship with the EU. But the organisation has warned, though, that the uncertainty surrounding Brexit could hold back private spending a lot more than forecast. The OECD has also downgraded its expectations of the Japanese economy. The organisation says the Bank of Japan has to rethink its policies if inflation does remain fairly elusive. Right, then a lot to unpack from the OECD a little earlier today. Our guide from Paris tonight is Elena Casa. She joins us now from that city. So the OECD's chief economist, she pointed out that the current rosy growth rates will not continue unless we see higher levels of private sector activity and a lot more investment. But can that really happen as central banks in Europe and in the US cut back on their low rates and this quantitative easing we've become so used to?
Well, the OECD wanted to make two key points, really. Firstly, that the upturn in growth that we're seeing now is cyclical, as in it's inevitable, really, after the previous recession. And secondly, that it's hugely dependent on those ultra-low interest rates and the financial stimulus that's been pumped into the economy, both in the Eurozone and in the US, which is now, of course, being slowly withdrawn on both sides of the Atlantic. Now, they were keen to underline that private sector investment is exceptionally muted, far lower than we would generally expect it to be at this moment in the economic cycle, and that if there's no uptick, if there's no investment, for example, in productivity, or no attempt by companies to increase the participation rate in the workforce to include more women and more older people, then there will be a downturn very soon ahead. Now, what the OECD says it can't completely diagnose, though, is why private sector investment has been so low.
Indeed, but that really is the nub of the problem, isn't it? I mean, companies haven't been investing to cover or replace existing stock of assets, but that's all happening at a time when the cost of capital, the cost of debt, has been so low. How do we explain that paradox?
Well, actually, the OECD report itself says that its researchers struggle to explain the paradox. In terms of the cure, they're keen to underline that it very much depends on individual countries. In the US, for example, they do believe that corporate tax reform is necessary, although they don't necessarily agree with all of the package that's being put before Congress at the moment. In the Eurozone, they said there's a sense of government starting to cruise, really, as economic results improve, and a concern, really, that they might start to think it's all uphill from here on in, whereas in fact lots of ongoing problems remain, particularly with low productivity in some parts of Europe and with non-performing loans in southern European countries like Italy and Spain, which must be addressed in order to encourage business investment, the report says.
Indeed. One last question for you, Elena. The OECD also forecasting US GDP growth next year at about 2.5%, but that's based in part on the expectation that these tax cuts, these Trumpian tax cuts, will happen. But given how fractious the debate on that has been in Congress, are those cuts really likely to happen? And if we take those out of the equation, will that 2.5% growth forecast still stand?
Well, as I was saying, the OECD isn't necessarily endorsing the Trump administration's tax cut programme in its entirety. The report actually says that there isn't enough link in that programme between cutting taxes and increasing productivity. So they're not necessarily saying that this tax cut programme is the only way to go. But certainly the idea of any bipartisan agreement on tax cuts in the US looks pretty fragile at the moment, with, for example, top Democrats Nancy Pelosi and Chuck Schumer cancelling a meeting with Donald Trump at the White House today after he tweeted something offensive about them. And so that does look to be on rather thin ice. And the OECD is saying some kind of reform to corporate taxes in the US is necessary. Otherwise, businesses there will never start to invest.
Indeed. We'll have to leave it there for the time being. Thank you for the update. That's Elena Casas. They're live, of course, in Paris.